Hi, I'm Jimmy. In this video, we're looking at the US economy. So we're going to go through different economic indicators to see if the indicators look more bullish or bearish to try to ultimately answer the question, should we invest now or do we think the stock market's going to pull back, giving us better buying prices down the road? Now, before we jump into that, I just want to show you real quick an investing platform that we have that tries to make value in companies quicker and easier. Basically, we do a lot of discounted cash flow, price to earnings, different ways to value different companies, depending on the company we're looking at. But with this company, we might be interested in their dividends, or perhaps we're interested in insider buying. Where are all the buys happening for a company like ExxonMobil? We might look at some of the information and realize, man, there's an awful lot of buys happening here at zero where they're being awarded shares. Kind of takes away from the impact of insider buying if that's one of the reasons to buy the company. So if you want to sign up to get access to this platform, I will leave a link in the description below. Basically, again, quick and easy way to value companies and try to do more research in a cleaner, simpler way. Plus, we do 3 private investing live streams per week. Okay, with that being said, let's jump over into our first economic indicator. So first up, we've got consumer confidence. Consumer confidence is one of the most important economic indicators because the consumer is such an important driver for the US economy. And as we can see, well, recently, consumer confidence ramped up a bit, and overall, this is a positive sign for the US economy. But we can see that even more recently, there was somewhat of a pullback. Now, I was on the fence with which way to score this. Do we give this point to the bulls or bears? I think that it is a positive sign that the broader trend over the past year or so is, in fact, heading higher, but it is pulling back. So I'm a little bit concerned about that. So I am actually going to take the easy way out here and give a point to the bulls and bears. We're going to call this a neutral point. We got one more neutral point coming up in a minute. But besides that, it gets more definitive as we go along. That being said, let's jump over to our next economic indicator. Now, this is a combo indicator that we've looked at before. Basically, it measures inflation, the blue bars, and wage growth, the green bars. The idea is that when inflation is higher than wage growth, clearly that's a bad sign. Things are getting more expensive for people. The amount of money that people are bringing in from a wage perspective are not keeping up with the increase in cost in goods and services. But recently, well, the fact that inflation is down as low as it is, and wage growth although it is pulling back, it remains higher than inflation right now, where it was negative before. This point has to go. Both of these have to go to the bulls because wage growth is still up at a relatively high level historically, and inflation, the Federal Reserve has done a fairly good job of getting inflation mostly under control. Okay, now let's jump over and look at jobs. So this is initial jobless claims. And this is going back the past few years. And as we can see, well, the trend recently has in fact moved higher. So this is a negative sign. This is a bearish point you don't want rising jobless claims. But if we were to look at this chart on a longer term perspective, now I will point out that I have scaled this chart. So we're mostly ignoring COVID because during COVID, as you could imagine, jobless claims went nuts. And if we're including that in the chart, you just can't see the other numbers. So to try to be able to maintain that, to be able to see our entire historical range, and again, this is going back 20 years. Well, the good part is, although the numbers have risen up, given the current level of jobless claims, we're still on the low end of the historical average. So as I alluded to before, this is another one of those that could go either way. So this is the final neutral point where I'm giving both a point to the bulls and the bears. So right now, at this point in time, with just these economic indicators, the economy's looking okay. Okay, now let's jump over to our next economic indicator, and that is the yield curve. So the yield curve measures the interest rate for US Treasuries for different time periods. So what are you going to get at for if you invest in a 3-month Treasury or 5-year Treasury or 30-year Treasury? In theory, the longer you invest, the higher the interest rate you should get, which means the yield curve should in fact be shaped like this. We want that upward slope. That would be a normal yield curve. But right now we have an inverted yield curve. We've had an inverted yield curve for a while. Pretty much shortly after they started increasing interest rates, the short end of the yield curve, the far left of the yield curve has gone up. And that's clearly a bad sign. In fact, they say that an inverted yield curve has preceded every recession for like the past 150 years or some crazy number. It's not a good sign. So clearly, this is going to be an easy point for the bears because this is a real problem. Okay, now let's jump over and look at housing. So this economic indicator is housing starts. Basically, how many new houses are being built. And we can see that recently, with higher interest rates and all, well, that number has gone down, at least pulled back a bit. Now, we can kind of double check ourselves by checking the average price of homes. Now, clearly, the trend higher is a good thing. Now, and I've been on the fence with this one for a while now. The trend higher is a good thing, but my hesitation with where it's at right now is that during COVID, things went a little nuts and the price of homes jumped up pretty dramatically. Now, what I expected was the last time we had a big jump up, well, that was followed by either a pullback or I was half expecting maybe it doesn't pull back, but just kind of stagnates for a while. But instead, housing prices have resumed higher. I have a real issue with this because houses are becoming, if not already, very expensive for people. And if you can't have a lot of people buying houses, or if you just have, let's say, a whole bunch of corporations buying houses, that could be a problem for the broader economy. So from an economic standpoint, I got to give this point to the bears because, again, this is a bad sign. Okay, now how about manufacturing? Well, this is the ISM Manufacturing Economic Indicator. And the key number here is 50. Anything above 50 implies growth. Anything below 50 is negative growth. It's really quite that simple. And when we look at this chart, well, we can see right now we're below 50. So the US manufacturing sector is struggling without a doubt. So when we jump back over to the economic scorecard, well, clearly we got to give this point to the bears because manufacturing is not doing that well. This is a negative sign because stronger manufacturing would be better all across the board. Okay, now to get a broader look at the overall US economy, how about something like debt? I don't mean debt for the government or anything like that. I'm talking about debt for individuals. Well, this is a chart of how many people, how many credit cards are more than 90 days late on their credit card payments. And we can see that right now, the number has gone up fairly high. In fact, compared to the past 20 or so years, the number's really on the high end. And again, this has to be a point for the bears because you don't want higher credit card debt. You don't want people not being able to make credit card payments. So from a broader economic standpoint, this is a real problem. Now, when we're looking at the overall scorecard, we can see that clearly, although we started somewhat strong, things are fairly negative for the US economy. And this kind of makes sense if we think about it, because the Federal Reserve is gearing up to start decreasing interest rates. And frankly, that should help in many of these economic indicators will be improved by falling interest rates. Outside of maybe housing prices, which in theory that would keep going higher and that could be its own problem. But to answer the question, do we invest now or wait for the stock market to crash? Well, falling interest rates has historically been a good sign for the stock market. So waiting for it to crash, I think, doesn't make a ton of sense. Although I do think it makes a lot of sense to buy good stocks at good prices, try to buy them at a good value, something depending on the industry that is discounted compared to its own history. Discounted cash flow could be good if we're going to use something like price to earnings. Compare it to its own histories. Try to get it on sale and then be a long-term investor. Over the long run, buying and holding works, especially if you're buying good companies. So as always, just keep dollar cost averaging. You'll be happy you did it over the long run. Now, if you'd like to sign up to get access to our Investors Grow website, I will leave a link in the description below. And if you're curious how to do a deep dive on individual stocks, I got a video called 8 Steps to Analyze a Stock. And this is the exact process I use when trying to analyze the company. If you'd like to, I'll leave a link right here for that and a link for that in the description below as well. Thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.